Hi, I'm Jeni Browne. A top of the morning to you all. I hope you're very, very well. Here I am full of beans, having had 2 weeks off work, and what a wonderful 2 weeks it was. I had a week in Greece in Corfu, which was absolutely lovely, but then I actually had a few days hiking in the Lake District when I got back. Absolutely incredible place. I know I'm getting old because I actually preferred hiking in the Lake District to sunning myself on a beach in Greece. So there you go. What can I say? It comes to us all eventually, but I hope you're all keeping really well and life has been very, very good to you. So let's get started. What we're covering off this week, we're going to do our usual rundown on what's been happening with swap rates and the pricing changes, and I'm going to do a bit of a roundup on where rates are sitting currently. We're then going to do spend a bit of time rather looking at the latest report from the Mortgage Works, which talks a lot about landlord sentiment, landlord plans. It's always really interesting to see how people are feeling, particularly as we go into kind of like the next kind of buying season, as it were, for landlords in September. So a bit to cover off there for you. And then finally, we're going to wrap up by having a deep dive into different tenancy types. Now, the reason we're doing this is because one of our wonderful viewers left a comment a couple of weeks ago saying actually it'd be good to understand more about different tenancy types. What we're talking about here is things like Airbnb, serviced accommodation, corporate lets, that kind of stuff, what lenders like, what lenders don't like, and why. Actually, it's always really interesting to understand what lenders' concerns are as well. So going to be doing that as well this week, so lots of good content for you guys today. Okay, so let's get things kicked off by looking at swap rates. And I have to be really honest, I was secretly hoping that I was going to go on holiday, and while I was away there was going to be some kind of like hallelujah moment, and I'd come back and swap rates would be much reduced, but unfortunately that hasn't happened. And actually, if I dare say this, they've gone up ever so slightly, which is really frustrating. No doubt will be connected in some way, shape or form to the inflation data that came out. So where are we? So 2-year swap rates are at 3.7. 1 month ago they were at 3.6, and actually before I went on holiday they were sitting around the same level. 1 year ago just over 4%. So the good news is that actually year on year we're in a better position, but actually month on month swap rates on a 2-year basis are up by 0.1%, and it's an identical story on the 5 years as well. So 5 years currently at 3.77. 1 month ago they were 3.66, and 1 year ago 3.68. So actually fundamentally year on year and almost month on month as well, there's just been no change on 5-year swap rates as well. So what does this mean for you in terms of for those of you who are sort of getting back into gear, you've had your holiday and all the rest of it, and you're starting to kind of get a bit more organised again? I don't know about you, but I've just put everything off until I've had the holiday, and I come back and I think, oh God, why should I do that? I should have been more organised before I went. But actually, there's lots of people who are they were waiting for the base rate decision to come out in August, which we had. It did exactly what we thought it was going to do. It came down by 0.25%. Therefore, no changes to swap rates because swap rates are already priced in, a 0.25% reduction in August. So actually what's looking likely to change are rates going to come down. And the very short answer is at the moment, I can't see any reason why fixed rates would change significantly either way. Now, if there was a piece of news, an example of that could be inflation has dropped down to 2%. It could be actually that the situation in Ukraine, the war in Ukraine, has finished, and that's going to help with food production. If the world were just a slightly more stable place, if the guy who ran America was slightly more stable, if there was more faith in our government, all this kind of stuff. If there was loads of good news, we could see actually then that the kind of forecast for UK base rate might feel slightly more likely for it to come down more quickly. That could influence swap rates and bring them down, which will therefore mean your fixed rates will come down. But at the moment, there's just none of that looking particularly likely. So the reality is that actually in terms of swap rates for the future, or for at least the next few months at least, I just can't see much changing. And I'm sorry, because I really wish that weren't the case. I wish I could sit here and say, we do expect fixed rates to start really coming down, but there's just no reason for that to happen. So unfortunately, guys, I think we are kind of where we are for the time being. But obviously, if things were to change in any way, shape or form, we would keep you posted. Okay, so moving on to lender pricing activity. Now I've got that kind of miserable bit out of the way. I bet you're wishing I'll just go back on holiday again and come back in another 2 weeks having tried a bit harder for you. So in terms of lender pricing, over the last couple of weeks, being really honest with you, there hasn't been a huge amount going on, and I don't see any real kind of value in letting you know that Santander dropped their rates down by 0.05% 2.5 weeks ago. It's not really relevant, but there has been a small number of lenders repricing. The pricing trend, I would say, has been downwards. There have been a couple of lenders who have gone up, and that would be in response to the increased, slightly higher cost of their funds in terms of swap rates, which we just talked about. But there has been some lenders kind of tweaking, and it really is like tiny tweaking, their rates downwards as well. So where does this land in real life? Like, what are we actually looking at? So as usual, I've tried to kind of encapsulate pricing for you, but obviously everyone's situation is different. What works well for one person wouldn't work well for another. So for example, if you're borrowing £100,000, what's going to be the best rate for you is going to be different than if you're borrowing £1 million. Your own circumstances will come into play, the loan to value, all these things. There's so many things at play. So all I can do is give you kind of like a rough guide. As always, if you do want to get a proper quotation, you are so welcome to give us a call. Have a look at our website, send us an email. We're not obligated if you get in touch with us to do anything, so that could be quite easy. But also there's actually a really handy rate finding tool on our website as well. You can just go on there and have a play around, and you'll start to see what the rates look like yourselves. However, you don't want to do that because you're watching this video. You want me to do it for you, and that's absolutely fine. So the scenario I've come up with you for today is a mortgage at 75% loan to value, borrowing a loan amount of £240,000. So what I've done here, just to kind of try and explain this, what I haven't done is just choose the lowest interest rate, because for me that's not really being totally truthful with you guys, because the lowest interest rate would have a very high arrangement fee. That's just how things work these days, and that's not going to be necessarily a good deal. So what I've done, and it's what we do at MFB when we're quoting our clients, is we tend to try and look for the deal which offers the best value over the 2 or 5 year period. And by that what we mean is how much interest you're going to pay plus all the setup costs as well. So overall, which is the deal which is going to cost you the least. So I suppose I'm going to caveat this by saying there are lower rates available, and also if the loan amount were different than £240,000, also there might be a better rate available for you, but this is just to kind of give you a guide. So if I'm an individual and I'm refinancing and I'm taking a 2-year fixed rate on a standard property, and I have got a portfolio of less than 10 properties, that's important as well. 2-year fixed rates are looking to be roughly from 4.09% with a £1,500 fee, 5 years from 3.87 with a £4,000 fee, and tracker rates from 4.64 with a 995 fee. Now these particular products also have the benefit of free valuation and free legals, which is always quite nice. But like I say, there are lower rates available, but they would come with higher setup costs. So these are the rates which work best in the round. Moving on to limited companies, so the same kind of caveats sit around this in terms of the numbers that I've used in the kind of process in terms of coming to particular rates. So 2-year fixed from 4.89 with a £1,499 fee, 5 years from 4.8 with a £2,400 fee, and trackers from 5.8 with a 999 fee. Now the eagle-eyed amongst you will notice that broadly speaking, the price difference between personal limited company is currently sitting at around 1%. So essentially, if you're thinking, I want to buy a property and I don't know whether to use my limited company or do it in my own name, which is going to be more expensive, you can pretty much sort of say quite safely that by using a limited company, you would pay circa 1% more on the interest rate than you would if you were buying personally. Obviously there's tax to also think about here as well, but that's looking like the difference. So there you go, bit of a roundup in terms of where rates are at the moment. But like I say, do have a look on our website. There is absolutely loads of information, or even better yet, just give us a call. Now, for those of you who are regular viewers of this video, you will know that I love The Mortgage Works report, because these guys spend an absolute fortune going out and surveying landlords and then collating information and then popping the results into my email in a very kind of digestible format, which is very good of them, I have to say. But it actually makes really interesting reading. So one of the reports they've released recently really talks about kind of landlords' confidence and landlords' plans. And I think, I always say this, as a landlord, it's actually really interesting to hear how the landlords are feeling, where the sentiment is amongst the market, just because, you know, being a landlord, you're sort of working by yourself, aren't you? So you haven't got like loads of other landlord mates to hang out with and discuss, unless you go to, you know, one of the networking events or one of the landlord associations. But I think it's always really good just to hear how the land's lying for other people who are doing the same job as you. So first thing they're going to talk about is landlord confidence. And what they say is that compared to a year ago, landlord confidence in the near-term prospects for the private rental sector remains largely steady. There's only been a modest drop in sentiment for landlord expectations for their own letting business, and also the prospect of capital gains as well, with the proportion feeling positive down to 35% and 18% respectively. There's been a slight increase in rental yield confidence, up 1% to 37%. So what they're essentially saying here is that they release this survey every quarter, and actually, broadly speaking, people are still feeling very much the same as they did in the previous quarter in terms of expectations for landlords for your own letting business, and also the prospect of capital gains, and a slight increase in confidence in regards to rental yield. So I think slow and steady is probably how I would explain that. The good news is that things haven't tanked. And what we tend to find is when you get these surveys, if they're being done in a period of time, like when the Renters' Rights Bill first got announced, for example, in Section 21, being abolished got announced, COVID, all these kind of things that we've had, the mini budget, landlord sentiment tends to kind of do this, understandably. So the fact that actually what we're seeing is a kind of calmer quarter in terms of how people are feeling is actually a really good thing. Obviously, we'd like to see people feeling, more confident, but actually no change. I would take that given the current climate. Now, in terms of market dynamics, they're saying in the next year, 38% of landlords plan to sell property from their portfolio. Now, that doesn't mean all of their properties. It means they might be selling like 1 or 2 out of 7 or 8, however it comes. But the key point being is that 38%, so over 1/3 of landlords are planning on selling at least one property from their portfolio in the next year. This is over 6 times the level who are expecting to purchase, just 6% of landlords. So 38% are planning to sell something and only 6% are planning to buy, which actually really saddens me. I had a really interesting conversation with one of my clients the other day, and they were saying that there is no escaping the fact that landlords are leaving the market, and I think that's absolutely true. However, what we are seeing is kind of the more, I don't want to use the word serious players, because I think every landlord is serious, but the kind of bigger players are now really kind of going out and starting to buy. So sure, there's lots of landlords who are planning on selling, but actually there's a smaller contingent of people who are investing, but those who are looking to probably invest fairly aggressively in light of the fact, and their kind of mindset is that actually at the moment house prices are at a point where they think they're going to start increasing. That's definitely a thing. Yields are still increasing, mortgage rates kind of are where they are. They just recognise that probably it's now a good time just to crack on in terms of growing their business. They're not going to leave the market, it's what they do for a job. So they're going to kind of look to try and expand things instead and kind of make a really good go of it. Now, what the report goes on to say is that the proportion of landlords putting up rent in the last 12 months is now 5% lower than 1 year ago. So previously, in the previous year, there were lots of landlords putting up rent. That number slowed down slightly. However, actually there's still a large percentage of landlords who are looking to put up rent in the next 12 months, 69% of you, in fact. So I think that actually is really positive to hear that in spite of kind of some of the things that are going on, the kind of external factors, the reality is that landlords are still able to, have been putting up rent and will continue to put up rent at a far less aggressive pace, I would hasten to add, but really just to kind of keep up with their higher costs. So I had a little read through this report, I had a bit of a noodle on it, and I tried to kind of think, is this a good or a bad report, or is it kind of indifferent? And I think actually it would be very easy to kind of read from this. Loads of landlords are leaving the market, and people are feeling less positive than they were last quarter. This is all really negative, but actually I think what I take away from this is that actually the resilience that landlords are showing in terms of their sentiment is quite incredible given the headwinds that we're facing at the moment. And I always say this, but landlords are like the most resilient bunch of people I've ever met. The stuff that goes on all of the time, and the fact that landlords just kind of dust themselves off and get on with it is absolutely incredible, while continuing to provide such a fantastic service. So really well done to all of you guys. But yeah, I just think it's a case of people are probably waiting to see how the Renters' Rights Bill shakes out. That's going to be coming in probably next month now. We've also got the kind of prospect of house prices starting to increase. So I think actually, if you are thinking about buying, now could represent a good time. We're not expecting to see rates come down anytime soon, or I'm certainly not at least. So yeah, I think it was just kind of one of those quarters that we'll just sort of say that things have stayed relatively static. Okay, now as I mentioned at the beginning, someone, one of our lovely viewers, left a comment asking me to talk about tenancy types, which I'm delighted to do. And please, if you have anything else you want me to cover off, just leave a comment. I'm so happy to do this, and I'll do my best to do your question justice. So to talk about different tenancy types and what they mean in terms of abilities to obtain mortgages, I kind of thought about how to answer this question. I thought what I'd do is I'd break it down into the kind of the key different tenancy types that we come across, at least at MFB. So obviously there's the standard one, which is your 6 month or 1 year AST. Now, and you can sort of take it as read that basically if you've got that in place, you're going to be absolutely fine. Lenders these days can't really discriminate if you choose to let someone who's on benefits. That always used to be a thing. So broadly speaking, standard tenancy agreements, you're kind of home dry with those. Now, the next type of agreement that we see a fair amount of are short-term lets. We have Airbnb, holiday lets and serviced accommodation. So what you will find is the key thing here is there are lenders who will lend on this kind of arrangement. They will have a different product set for these types of lets than your standard AST let. And the real difference is the rental income or the income figure that lenders are using when they're calculating the affordability for the mortgage and rental calculation. So some lenders would say, okay, we absolutely accept that you're going to be renting your property out on an Airbnb or a holiday let basis, and that's fine by us. But the rental calculator, or the rental figure, the income figure we're going to use from an affordability perspective is going to be as if you were to let the property on a standard AST, which will invariably be quite a bit lower. Why do they do this? So the lenders who take this position, their kind of view is that actually, if it all goes horribly wrong, you do holiday letting and you realise that you absolutely hate it. Most landlords' default position would be to go back to just renting out on an AST rent. So actually this kind of safeguards the lender's position rather than you saying, well, okay, we're going to underwrite the mortgage based on you bringing in, say, £50,000 per year. You go to do it, realise that actually doing holiday lets absolutely sucks. I'm not saying it does, by the way, but that might be your experience. So actually you're going to re-let the property just on a straightforward AST and suddenly the rental income drops down to £18,000 a year. Is that going to be affordable for you? So that's why these lenders take this position. However, there are also lenders who are quite happy to accept the income the property is going to let as a full-on holiday let as well. So these lenders are a bit more specialist. Actually, some very good rates. One of the examples of a lender that springs to mind for these would be the Cumberland Building Society. Very, very competitively priced, absolutely magic at doing holiday lets and using the holiday income as well. So it just varies by lender to lender, but that's just the one thing to be mindful of. Serviced accommodation is a massive problem. There's lots of people who do this. And one of the questions we get asked often is what's the difference between Airbnb and a serviced accommodation? And I think the answer is honestly, it's a very hard one to answer. It's quite a great thing. But I think the key thing is that actually it's about the sort of day-to-day cleaning and ongoing management the property receives. But what you'll find is that service lets lenders tend to not like these at all. But actually Airbnb is absolutely fine. It's just something to be kind of cognizant of there. Now, the next type of let that we get is housing associations. So where you're not actually renting the property or you are renting it to a tenant, but your agreement is with the housing association rather than with the tenant directly. So you would sign an agreement with the housing association. They generally take the property from you for sort of between 3 and 5 years, and they just pay you a set amount of money every single month. And that tends to be a figure which increases in line with some kind of inflation data. And what you will find is that actually, irrespective of whether the property is occupied or not by a tenant, you just continue to receive your rent. So that's a really, really nice thing. Now, there's quite a lot of lenders who don't like that arrangement. They just want you to be renting the property out on ASTs because it means that actually in the event of repossession, if you're 3 years into a 5-year lease with a housing association, where does that leave the lender in terms of repossession? Have they got to repossess the property with the tenant in situ? Can they break that lease agreement? So that's seen as slightly more risky for lenders. However, there are lots of really good lenders who are actually very comfortable with housing association lets as well. So a good example of that would be someone like Paragon. Absolutely fantastic there. So I think with housing associations, the reason people like them is guaranteed rental income. The housing association also have to give the property back to you in the condition they found it from. So it's a bit like a commercial offering in that regard. You get paid rent no matter what. So a lot of people actually switched to these after COVID. The downside is that actually, there's quite a lot of lenders who don't particularly love them only because of their position in terms of repossession and getting a vacant possession on completion. So that's housing associations. And there's also corporate lets. So corporate lets are where you are letting the property to a company. And this is very, very similar to housing associations in terms of you tend to find the agreement with the company would be between 3 and 5 years. The lenders' positions on these vary quite a lot actually. So for those lenders who can accept corporate lets, and not everybody does, for the same reason that they don't all accept housing associations, it's the same kind of concern. Some lenders say, well, okay, we're very, very happy that you're going to let the property to a company, but actually who is the company? How many employees does it have? So they don't want to be lending to some little fly-by-night company. They want to be lending to sort of where the tenant's going to be a quite professional company instead. When they look at the company and who they are, they certainly don't want to see that it's a company that actually is going to be using the property to house vulnerable tenants, that kind of thing. So there's a bit of kind of digging into who actually is a tenant going to be here. So one example could be that the company is, you're going to let to specialises in relocation for executives coming from overseas to work in the UK. It could be that you're renting the property to someone like Google, and they just want it to house their staff when they come over to work on a sabbatical in the UK. So that's kind of one example. But there's lots of other kind of variations on this as well. So I think from a lender's perspective, it's just really trying to understand who's going to be in the property, and actually if they get to the position where they have to repossess the property because you haven't paid your rent, how sure is their position going to be on that basis. Now, just to kind of touch momentarily on a word that I used earlier, which is vulnerable. So what you will find is that the lenders who are happy to lend, housing associations and or companies, are going to be very, very mindful about whether the property is going to be used to house vulnerable tenants. And vulnerable tenants can be things like migrants, it can be people with mental health issues, or any kind of disability. It could be women seeking refuge. It kind of covers a large kind of range of possible situations. But the key things for most lenders is they're very, very uncomfortable lending where the tenant is going to be someone who is classed as vulnerable. Why is that? I think we can sort of dress this up, but I think fundamentally, being really candid, I don't think any lender really wants to have to be mentioned in the press as saying, you know, such and such lender makes X number of vulnerable, you know, domestic abuse victims homeless as they repossess property. So I think for these guys, it's mainly a kind of PR thing, if I'm being brutally honest. I'm sure, and we're doing some Meet the Lender episodes actually, so maybe we'll ask one of them and see what they have to say about it. But that's the impression I get. Now, there are lenders who are happy to accept some vulnerable tenancy type arrangements. So for example, if you're going to be using the property and letting it to Serco, they are an institution where some lenders can get comfortable with that. So there are kind of variations on this. So for everything I'm saying is always like, and there's an exception. But broadly speaking, you will find that if you're going to have vulnerable tenancy, then 99% of lenders are just going to step away from the transaction. Now, the other thing that the person who left the comment requesting this last week or a couple of weeks ago said is the implications of the Renters' Rights Bill coming in, the abolishment of ASTs and the kind of introduction of fixed term contracts. Now, in terms of how it's going to impact the lending space, at the moment, the lenders are saying it's going to have absolutely no impact on them whatsoever. They're just not worried about it. Their position is that actually they don't see that lots of tenants want to be continually moving. Most tenants want to move into a property and be able to stay there for the duration. So they don't see that the fixed term contracts are going to really have an adverse impact on the market. Now, obviously, once we are in this, in the trenches fully and we can start to see the impact of fixed term contracts, maybe they will change their position if it doesn't kind of work that way. But fundamentally at the moment, the lenders are saying that we know landlords don't like it, it's not great news, but actually from our position, we can't see a huge amount of change in tenant behaviour. We still think people will stay on the properties and rent them as if they were on a sort of longer term tenancy anyway, so no changes there, which is good news at least. And there you go. That's us from my first week back after my holiday. I hope you found that helpful. And like I say, honestly, if you have anything you want to ask about, I'm so happy just to kind of chat about it. For everybody who's sitting there thinking, oh, you know, this is interesting to me, but maybe it's not to anybody else, I can guarantee there's at least another 3 other landlords who are also kind of interested in it as well, and probably lots more to boot. So do ask away. Very, very happy to talk about all the things that are interesting to you guys. That's it for this week. I will see you in September. Have a fantastic weekend. Do look after yourselves. And as always, if you have any questions, you know where we are. 0345 345 6788. Look after yourselves till then.